Yo guys, this quarantine has been crazy, and it's pretty much the same for everyone. I've been bored, decided to finally get Robinhood, try it out, see what I could do, and like any normal person, I then joined Wall Street Bets, and that was really not that fun. As you can see, I'm pretty lucky to be up on my portfolio, but those guys are crazy, and they'll make you do some crazy things if you follow in. So now I'm ready to join Theta Gang because I just cannot put up with this anymore. You can see pretty much all last week I just sat in cash. This was me cashing out a USO leap I had just because that was stupid. But yes, now I'm ready to join Theta Gang, and the first strategy I'm going to try to employ is the wheel. And when I was looking to implement the wheel, I wanted to pick a stock that was trading for about $8. That way I could maximize the premium I could obtain selling a cash covered put. So if we jump over to JetBlue here, they were one of the perfect candidates, but I'm just not feeling it after looking into them a bit. So as you can see here, pretty much exactly $8 if I go to trade JetBlue options and I were to go for the $8 put. You can see I can get about 10% premium on that. So this does last for about 3 weeks. 10% over 3 weeks is still pretty good, but it means I'd be playing earnings. So I had to look into them a bit because, that's pretty scary with these airlines. And so before I jump into some of the things I was looking at, let's just talk through this real quick. So obviously this 10% premium would be pretty good. If it stays exactly here, I'd collect it, keep my cash. So I'd put my portfolio up at around 930. And the downside is if I got assigned, I would have 100 shares of JetBlue for the $7.20 cost basis. And that's only 9% up above the 52-week low. So really that's not that scary. But it is the airlines, guys, and we just don't know when they're going to recover. And I think the scary thing is that they could experience a waterfall kind of like the banks did. So if you look at here, let's pull up Wells Fargo. All the banks were posting earnings not that long ago. And when they did so, you can see this was the day before they started posting earnings. And then overnight, Wells Fargo, JP Morgan posted. And then I think it was US Bank next. And I forget who it was after that, but it just kept going boom, 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 boom. And overall, from this peak to the bottom here, this represents about an 18% loss, and it's there for almost all of the banks. And so while I'm not saying that exactly the same thing's going to happen with the airlines, I am seeing almost all of them are reporting in the next 2 weeks. Delta's already reported, and they didn't drop at all, really. But they're all reporting in the next few weeks, so even though they're beaten down and haven't recovered that much, I think it's a really bad time to be holding an airline stock. And that goes especially for JetBlue. So I'm going to switch over to their annual report. And this is in the risk section. And this is one of the biggest things that kind of stands out with them. And that's that their business is very, very dependent on New York. They're trying to become New York's airline. Here it talks about that any disruption to JFK would be huge for them. And obviously it couldn't have been much worse because that is the hotspot of America. But for them, half of their flights originate from New York, and that their operations account for 36% of the seats offered from JFK. So altogether, that is really not great. And it makes me think that because they're so dependent on New York and New York's been hit so hard, they might have suffered a little bit more in the earnings than the other airlines. Because even when Congress was talking about this coronavirus relief bill, they were talking about how some areas just need flights. So Alaska and Hawaii, places like that, they still need flights. And that's why they're requiring airlines to still maintain flights. So obviously, airlines that are maintaining flights in that city are more likely to be profitable than airlines that aren't, because obviously they have people that are going to be on those flights. So and then there's other places they talk about these risks. They're basically all the same. And it's not exclusive to JetBlue. Obviously, everybody's suffering here. But just with the fact that it's New York, they're really in a tough spot. So here you see that extended interruptions are obviously a bad thing. That makes sense for any business. I just think these are also important things. They're talking about how their fixed obligations are so high, it might make it hard to meet other fixed obligations in the future. And then it also talks about incurring any additional debt would put them in a major constraint. So with the PPP that's been passed, that's obviously been the case. So the grant, not so big a deal, but the loan, it puts a little more stress on them. So I'm going to jump over here. This is kind of what their balance sheet looks like. So cash and investments, they have about $1.3 billion. And then over here are their current liabilities. And this right here is per quarter. And this is relative to the Q4 2019. So using this as an approximation, obviously, it's still not great for them because one thing in there, it mentions fuel is one of the highest costs here. And that's obviously true. The PPP takes care of this. But fuel, they mentioned they bought a bunch of forward contracts, which means they're not really benefiting from the crash in oil prices. And you might think, okay, Q1, no big deal. They also have those for Q2, so they're not going to be seeing any benefits for the next couple months either. And since that's one of their biggest liabilities, I just don't see them really benefiting in the long run. Obviously, salary's fine, landing fees will be down, and potentially so will marketing. The other things, it's harder to judge, and in general, it just looks like they're going to be burning cash. As far as debt goes, they have $2.3 billion outstanding. $300 million of that is set to mature this year, which really isn't that big a deal with this cash. The bigger deal is this burn rate, which has been enough to tell me that, I'm just not willing to play earnings. I'm going to try to find something else. The last thing I'll talk about real quick is this kind of evaluation. Basically, the idea is take the current earnings and the projected growth rate year over year, your desired rate of return, and how much safety you want on that return. And then you can calculate the price you should be paying. So if we look here with the 1.91 earnings, moving into the future and then back, that gives us a fair price today of 7.3, which is above my cost basis. But again, that's just a little difficult to cope with. Now, this is influenced by the lower PE ratio that it's trading at now. So if I jump to this chart, this is what it would have looked like, not in January, actually in February. And this PE ratio is the industry PE ratio of all airlines. JetBlue's was actually around 11. But regardless here, you can see with a PE ratio of 10, you would want a share price right now of 8.82. But that is highly reliant on the growth rate being 14% year over year. And that's just not going to be the case anymore. I mean, they're going to be down huge this year and probably into next year because the likelihood of a huge bounce back and people going on flights is pretty low. So if we were to drop this pretty low, like just look at like 5%, 8.4 is the fair price. And if you want to be really safe with a 50% margin of safety, you go for 4.2. So if we change that as well, you can still see 6.3. That's around the 52-week low. That's really the safe price given a conservative growth rate. And because I'm still learning, I don't really know how to project a growth rate. But right now, I just don't want to get in this because I can't understand it fully. So all in all, I'm just not convinced on JetBlue. You can see here is some flight data that shows 50% of flights have been canceled. So that kind of speaks to the reduction in cost when we were looking here for landing fees and sales and marketing. I don't think maintenance is going to fall. Some people have speculated it might even increase as they try to revamp their planes in a hope that once they reopen, that'll increase their sales relative to the competition. But in general, guys, I just can't see it right now. So I'm going to be looking at something else. In the near term, I'm still going to consider it, and I might even buy a put in the short term to try to sell it before earnings with the IV run-up. But I'm still going to look into that and not make a hasty decision. The other stock I'm going to be looking at next is Halliburton. And in comparison, this is a little safer because it's right in the 892 window. That means I can sell an 850 put if I want to. And they do offer weeklies here, which is nice. And my target right now is to try to make 2% with each of these that I do. That's what I was seeing with Kamikaze Trader. Now, obviously, as a new guy, I don't want to rely on that. But just looking at it right now, selling this put right here would put me right at 2.5% gain if it actually pans out. Now, of course, it is oil, which is a little scary. That's why I want to look at Halliburton in general. I do think oil's kind of due for a Trump pump, but that is yet to be seen, and I don't want to be banking on that as I, enter a deal. Also, this 22 cents is going to go down because it hasn't been recalculated with the decrease in theta since Friday. But guys, hopefully you found this helpful. I really tried to, do my research on this to see what we could find out. If you did find it helpful, please consider rating this video because it'll be helpful for me to see if this was a helpful presentation. And of course, if you did like it, please feel free to refer a friend. If you didn't, refer an enemy. Or Wall Street Bets, I guess. But with that, guys, I'm going to get out of here. I'll see you next time.